There are a lot of financial ratios and numbers out there, and it can feel quite overwhelming. But ratios like PE or ROE, they help us identify whether a stock is actually worth investing in. Keep in mind that a good business does not automatically mean that it will be a good investment. So in this video, I suggest you grab some pen and paper or open a spreadsheet file as I give you some very direct and clear instruction as to how to pick a stock using information that is already available to you. Hello and welcome back to my channel. If it's your first time seeing me, my name is Sujuti. During the day, I am a full-time analyst at an asset management company here in London, and by the evening, I run my passion project, which is all about investing, personal finances, and understanding the financial market. If you want to grow your money through investing while also trying to figure out what's going on in the world of finance, then do consider subscribing to my channel as I upload every week using only well-researched content that I have knowledge and experience in. Now that we have that out of the way, here are some important side notes. In this video, I will be using Trading 212 app to get all the financial ratio for the company that I will be researching. If you don't have Trading 212, that's absolutely fine. You can use any other platforms that you usually use to invest your stock, or you can head over to Yahoo Finance, which also have some very good high-level ratios and fundamental data at a company level. Since I am in the UK, I wanted to analyze a company from FTSE All Share, and I wanted the company to be well known, that we're all familiar with, but not a pure value or a pure growth company. And so the company we're going to analyze today is Unilever. Analyzing companies using financial ratios to begin with is what we call bottom-up fundamental analysis. And in this video, we're going to do exactly that. An important thing to note about fundamental analysis is that you have to compare the numbers to a competing stock or an industry or the overall market. So for this reason, I have two extra column that I'm going to compare the numbers of Unilever with, and that is the overall FTSE All Share market and the consumer goods sector. Every company that are listed, they always fall within one of the 10 sectors that are well known in the industry. Unilever, they fall within consumer goods sector, which is why I picked this sector to compare my numbers with. So without further ado then, let's get right into it. I've just loaded Unilever onto Trading 212, and this is the first view. Of course, this is the price return of the company. As you can see, it made up for most of its losses during COVID. So it had quite a good V-shaped recovery here. Scrolling down, it's always a good idea to read a bit more about the company. Here is more qualitative ways of saying what the company does and how it makes money. So few key points to pick up from here is that Unilever is a consumer goods company. I think it shouts a lot of brand loyalty about this company. If you keep on reading, you'll see they have quite a few segments within consumer goods sector. So personal care like cream and deodorant, things like that, and food as well, and home care. So they have quite a bit of diversified revenue sources when it comes to this sector. Carry on reading down. Another important point to pick from here is where are they actually selling? How are they making money? From which countries? So the company, they operate in more than 100 countries, and they sell their products in more than 190 countries. This is pretty good because it means that Unilever's revenues are quite well diversified, actually very well diversified. Some key ratio here, and I'm not going to go through this because I think if we click on all ratios, we can actually dive deeper into the key ratios that we're going to pick out in this video. So let's just do that. Oh, by the way, I forgot to mention one thing, sorry, which is just the market cap. I mean, Unilever got 127 billion pounds in terms of market cap, which stands for market capitalization. And this is essentially the price of Unilever for each share multiplied by number of shares outstanding. So this number is pretty big. It highlights that they're a large cap company. And the good things with large cap company is that they tend to be a bit more stable compared to smaller cap company. Unilever, as you would know, is one of the top 10 holdings within FTSE All Share. So it automatically highlights that it's literally one of the top largest companies in the UK. So those listed in the UK. Right, so moving into all ratios. The first page, the important one here to pick is the beta number. So what is a beta? Beta highlights how sensitive the company share price is to the overall market. So a market index or a benchmark such as FTSE All Share, they will always have a beta of 1. Compared to that, a company or a sector that's got beta below 1 highlights that they are generally a defensive company. And if it's above 1, it means they are more aggressive. What does that mean in terms of numbers? Beta of 0.34 highlights that if FTSE All Share were to go up by 10%, Unilever would only go up by 3.4%. Now, it may seem like they're not going to outperform during the rising market. But think about it. As we've mentioned, this is a non-cyclical consumer goods sector. So if FTSE All Share to go down by 10%, then Unilever would only go down by 3.4%. So it's going to outperform the market during a downturn. And that's exactly what this company is there for, give you some of the stability during a recessionary period. Let's then move on to valuations. Valuations are a good place to start. So what are valuations? Valuations are metrics or ratios that you would use to figure out how to value the company. Is the company worth buying? A very popular measure of valuation is price to earnings ratio, so PE. So lower the number, the cheaper is the company perceived to be. Because at the end of the day, this number is trying to tell you what price am I paying for a unit of this company's earnings. On its own, they might not tell you much, because if you were to quote a number of 23, I mean, what does it mean? Yeah, I see it's a PE of 23, but again, as I've mentioned, in order to identify whether the company is actually a bit cheaper, we have to do it in a relative basis. So different ways of comparing it would be against the overall market, so FTSE All Share, as I have on the Excel file, or by the industry, which is consumer goods industry, which I also have. As you can see, they have lots of different ways of highlighting the PE ratio of this company. We're gonna pick the number PE excluding extraordinary items last fiscal year. So the top number, which is 23.92. Extraordinary items are essentially those items that are non-recurring. So for example, say during COVID, Unilever had to spend a certain amount of money extra to train their workforce. Now, that's an extraordinary item because it is unlikely to happen in the future. It was a one-off cost, right? So by excluding that, you're actually going to get a better picture of the true earnings of this company going forward, which is why we're going to go for that. The next, you have other valuation metrics like PS, which is again buy per sell. Another one we're going to look at is the PB measure, which is also quite popular. This is price to book value per share. So book value of a company is almost like the true snapshot of how much the company is actually worth on paper or by book. This is the total asset minus total liabilities of the company. Companies that operate with a lot of tangible assets and liabilities, this is a really good measure. So companies within the banking sector, because banks, they typically are valuated at the end of each business days, because with banks, you know exactly how much of their assets are, how much the consumers or people like us, we put into the bank. So they can valuate every day and get a true picture of their asset liabilities. So using PB measure for banks are perfect. However, there are of course other companies and other sector where PB is not a good measure, like a high-tech growth company, because most of the growth high-tech tech companies businesses are made with intangible assets. For example, intellectual properties, because it's quite intangible, it's not captured within the book value of the company, which will distort the number for PB. So at the end of valuations, we have the dividend yield number. So for Unilever, the current dividend yield is 2.95%, so around 3%. Dividend yield basically tells you how much money can you expect by investing in a company over 1 year. So if we were to say invest £1,000 and the dividend yield is 3%, then you can expect to get £30 as pure income over 1 year just by investing in this company. Now let's move on to few growth metrics. Investing in a good company for the long term, a good measure would be to see how well they've actually been doing over the last few years. You would want to have some sort of positive growth if you're ultimately investing to grow your initial capital, because just as the company is likely to grow because they've been growing steadily or aggressively over the last few years, so will your overall capital. A good measure of growth, the popular one that we use would be the EPS. Again, this is the earnings per share that we use for the PE ratio. For Unilever, the 5-year EPS growth is 5.6%. What this means is that over the last 5 years, they have grown their earnings by 5.6%. Another good example of growth would be DPS, which is the dividend per share at the bottom here. And they have a dividend growth over the last 3 years of 9.7%. I mean, that number is pretty good. What this means is that over the last 3 years, they have actually grown the amount of dividend per share they've given to you, the shareholder, for investing with them. Investing in a company that grows their dividend is actually pretty good because it gets the maximum amount of compounding effect. Compared to investing in a company that just gives you a high dividend yield but does not really grow. So the number here is actually pretty good, especially if you compare to the overall market or even the consumer goods sector. So 10% is actually pretty good. Next, let's move on to margins. Where's that? Here. At the end of the day, profit loss of a company is the ultimate measure of how successful the company is, right? So there are different ways of looking at profitability. You have the gross profitability, net, and operating. I tend to usually look at the net profit margin because with net profit margin, you are looking at the purest form of profit. So it's net of tax and all sort of cost and things like that. So this net profit margin, what this tells you is that how much the company is keeping as profit from all its sales. So in terms of number or the ratio, it is the net profit over revenue. That's the net profit margin. Generally, if you say a 10% margin, that's a pretty good number. But then again, observe caution when you're using these metrics to value different kinds of companies. Here we're looking at Unilever. This is a perfect measure for looking at Unilever because they've been in the business for a long time and they have a long history of operating as a company. But if it comes to other high growth tech companies, which are quite popular nowadays, observe caution. Because a lot of tech companies, especially if they're new, well, relatively new, they tend to have a negative profitability number. For example, Tesla made its first profit only this year. So they have been negative on their profitability over the last few years. And Amazon took 10 years to be profitable. That's a long time, right? So try not to look at this measure of profitability for tech companies and be disheartened by it because they just don't tell you of the future, right? So that's the main point here. Next, we should move on to financial strength. It's right next to it. So financial strength of a company is really telling you the balance sheet strength of the company. How robust is the company? How well can the company handle negative financial event? There are quite a bit of ratio we can look at using the company's balance sheet. And the first one here I'll look at is the current ratio. Technically, this is current asset over current liability of the company. It highlights the ability of the company to pay its short-term liabilities with its assets. So any number above 1 is pretty good. If you see a number of 2, it means that the company can twice cover its liabilities with its assets. From here, another good measure to look at would be the payout ratio. This ratio is pretty good. It's very important one actually to look at if you are investing in a company for dividend, because this tells you how much of the earnings per share, so net income of the company, is paid out as dividends to its shareholder. As a dividend investor, you would want the number to be above 50% at least. But you don't want the number to be too high though. If it's too high, it may mean that the dividend paying strategy is not very sustainable for the company. Because you have to think about this. If a current dividend payout ratio of the company is say 90%, so they're paying out 90% of their earnings as dividends to their shareholder, which they don't get to see, right? It just comes to our pocket. Can the company continue to pay that 90% in the foreseeable future? So that's the kind of question you have to understand. Now, next one, let's look at debt to equity ratio. So this ratio helps us to identify, is the company too levered? Are they taking on too much debt? Because remember, as common shareholder of the company, if the company goes bust or goes into liquidation, then the debt holder are the first to get their money back. So if this ratio is too high, then the likelihood of you getting your money back is low, right? So a safe level for a debt to equity is ideally around 1.5, because companies do tend to take on debt so that they can grow and expand. So they are likely to have some debt in their balance sheet, but you don't want that number to be too high. And finally, let's look at management effectiveness. So we call these ratios quality ratio. How well is the company operating with the money that they have? So the money that you've invested in them, or the money that they have as assets. From here, I'm going to pick on the ROE, so return on equity ratio. This is essentially the company's return on its net asset. So net income over asset minus liability. A number above 10% is generally good, but then again, it will vary by industry and company. So for Unilever, they have a number of 45, which highlights that it's a pretty good quality business. You are getting a high return on your investment and on the equities that they have. So it's of course something to consider if you're into quality investing. Okay, so I think we have most of the ratios on our Excel file. So let's go back and compare them to FTSE All-Share and the consumer goods industry. So based on our analysis, would you be buying Unilever? How can you summarize the company? Well, we know that per the financial numbers, it is a well-run, good quality defensive business that tends to grow its dividends. Although it's quite expensive when you compare the numbers of Unilever to the overall market or the industry that they operate in, but they do also provide a very high return on equity. So here's the thing, at the end of the day, there is not a single company that will be the perfect investment for everyone out there. It really depends on what you want out of your investment. So here's the question for you. Would you rather have quarterly income coming straight to your bank account, or do you prefer to have your initial investment grow much faster? Why don't you comment that below? And if you haven't subscribed already, do consider subscribing, as I upload every week using contents just like this.